Welcome to the Inside Out Money Podcast.
Can't even recognize this place. Too many pieces of our past mistakes.
Hi, I'm Maggie, and I believe real change starts from the inside out. So let's work together to improve our money and our lives from the inside out. We will explore all things money and our relationship with it. Join me each week with a rotating set of co-hosts, friends, and interviews. Let's jump in.
It's time, we going round and round and round and round and round.
Hey, Andrew.
Hey, Maggie.
There's just a lot going on in the world. I was trying to even decide
You're right.
how to begin this discussion.
I mean, I was going to say, not a lot going on right now, right?
Not a lot going on. Yeah, don't read the news.
Don't read the news. Yeah.
Yes. Okay. Actually, I want to start with some discussion about the news and headlines. But before we do that, let's do two things. One, let's remind people where you're at. This is the Inside Out Money Podcast. Welcome. This is a podcast focused on redefining wealth from the inside out. Every week, I speak with a rotating set of co-hosts about a different financial topic to help you improve your financial mindset and tactics. Today, Andrew is here, and we're going to talk about what's happening in the world, in the market, in the economy, and how it is impacting our everyday lives, how we expect it to impact our lives more in the future, and also our investment approach. And are we changing? We'll get into this, but are we changing how we invest and what we invest in? But what do we got to do something important on this one.
Oh, yes, the disclaimer. All right, so before we dive in, definitely this episode needs a disclaimer. We're just two people with microphones, not a crystal ball or financial wizards. The information shared here is just for entertainment and discussion only and should not be taken as financial advice. Your money is your choices. Your financial situation is unique, and you're solely responsible for your financial decisions. Always do your own research and consult with qualified professionals before making any financial choices. Basically, we're just here to have a chat, not to manage your portfolio.
Yeah, totally agree. Okay, let's get to some headlines. This is not in the show notes. I'm going to do something that even is just a little fun surprise for Andrew. Surprise is the wrong word.
I love surprises.
Yeah, okay. So I want to read you a bunch of headlines, Andrew, and then I want to know what you think.
You want me to react to each one, or are we going to read
No,
I'm
going to read you a bunch.
Okay, all right, cool.
And then at the end, good question. At the end, I want to hear how you feel, okay?
Okay.
So these are a bunch of headlines from reputable news sources, of which I will name.
In the last week or so?
We'll get into that.
Okay.
So Slate.
Mm-hmm.
Yes, stocks could drop 50%. The Economist. Overvaluation, the evidence. Business Insider. Market history is calling, and it's saying stock performance will be a crappy for another 10 years. Market Watch. Here's how you know the stock market is hugely overvalued. CNBC, if you follow Warren Buffett's methodology, stocks are significantly overvalued. Business Insider, a stock market crash of 50% would not be a surprise or the worst case scenario. Market Watch, this is the most overvalued stock market on record, even worse than 1929. CNBC, any way you look at it, this stock market is overvalued, Goldman Sachs says. Bloomberg, the world's most inflated investment could be U.S. stocks. And last, CNN, caution, U.S. stocks have rarely been this expensive. How does that make you feel about the future of your portfolio and our investments and, I don't know, the future?
Well, so a couple thoughts on that. First, all of those reputable organizations are media companies, and they make their money on eyeballs. And they are not going to get eyeballs if they just say, yep, things are just fine.
Yeah.
That's their headline, right? So, I love Jim Cramer on CNBC, right? The reason why people watch CNBC is because the more outlandish the headline, the more fringe the commentary, the more eyeballs it generates. And so, people... Morgan Housel, my buddy, has talked about this, right? That the fear of the downside is a very strong force, right?
Yeah.
And it's a stronger force than the potential positivity of the upside.
Yeah.
Right?
Well, that's a great quote. You asked the question of were these from the last week?
Mm-hmm.
So the punchline here is all of those headlines were from 7 to 10 years ago.
Awesome. Yeah.
Between 2014 and 2017. And I actually took those from, just to give credit where it's due, I took those from a Money with Katie episode where she did the same thing and read those headlines. And I heard them and was like, oh my God, what am I doing with my life?
Right.
I was like, I quit my job a few years ago.
Yeah.
So I think it is to like, assuage those fears and say, again, not to minimize anything in terms of the risk involved in the stock market or anything like that. But I do think it's a good reminder of, some of the things that you might be worried, you as in the listener and ourselves might be worried about today based on what's happening in the world and the news and actual recent stock market performance, which has been, heavily down in the last, few weeks, which we'll talk about, is, there were times like this where the outlook and the headlines and everything else were bleak and sensational and everything else. And there was, record performance after that. Mm-hmm. So I think it's just a good reminder to people. I hope that serves as a reminder to people that, well, we'll get into what it serves as a reminder for, right? Because I can't even like summarize it in one statement, but to not freak out, to like kind of calm down, take a beat, take a breath, and like understand what's actually happening and what it might mean for us and the broader economy.
Yeah, I think our goal here is to be the anti-headliners, right? Our goal here is to calm, to be a good voice of reason, to put things in perspective that this has happened before, this will happen again. I remember, if I look back in my own history, I didn't really start heavily investing until 2010. And, we'd spent a lot of time investing in paying down our mortgage. And so while I had stuff invested in the market via 401k and things like that, most of our heavier investments didn't start until around 2010, 2011. And I even remember back then having conversations with friends and colleagues. We'd just come out of, the 2008 recession had hit, and the market didn't hit bottom until kind of mid 2009, I think. And then, that period from 2010, 11, 12, I remember very clearly with one colleague, I had a conversation in like 2011, 2012, and he was talking about how, I just think it's just not the right time that, stocks could come down again. And like, I vividly remember this conversation because as you go back and you look at where the S&P was in 2012.
Yeah, that was a great time.
Right? And you think about like, what if you had if that fear had taken over me and I had stopped dollar cost averaging into VTSAX at that period of time, and you look at what even some small adjustments in that strategy, if I just say, you know what, if I pulled back for a year on that and you play that forward, what that would have done to your portfolio if you had if you'd taken over the fear, if the fear had taken you over and you had stopped, and it would have made a huge difference in your portfolio.
Yeah, it's a great point. And we're going to get specifically into like what we think you should do towards the end of this episode. Yeah. But we want to start with a bit of a foundation or framework of what is happening in the economy right now. And again, we're going to like talk about what's happening in a level of detail that for some people that don't like to nerd out on this might feel overwhelming and like stressful. But I would say back to the like, we're actually trying to remove some of that anxiety and stress from you and like give you a sense of calm. We want to explain this stuff to you for those of you that want to know it. But if this is like over your head and more than you want to know, and this is sort of like, quote, inside baseball for you, which most sports things are inside baseball for me. So it's ironic that I use that reference, but don't worry about it, because we're going to get into like what really matters and what you need to like worry about at the end of this. But like, let's talk about the economy for a minute. And I think it's helpful to talk about unemployment and job loss just for a quick minute. And Erica actually shared a couple episodes ago on our 100th episode that she had gotten laid off like the day we recorded that episode, which is very sad. It's happening a lot lately, unfortunately. And I do want to just like mention a few things about it because it's one of the data points in the economy, right? So as of February...
And it's usually the one that's most top of mind to people, right?
Yeah, because your job is like your livelihood and how you pay your bills and, right, people watch unemployment very carefully. And so it's actually interesting, though anecdotally, I feel like there's like a lot of job loss lately because I just happen to like know a lot of people. So it's like confirmation bias. As of February 2025, which is, the last full month we've got data for, the US unemployment rate was at 4.1%. That's actually considered relatively low, though it has increased slightly from some, other earlier, even more low numbers. The economy has been adding jobs for the 50th consecutive month as of February. But there are reports of increasing job cuts. There were 172,000 announced in February of 2025, which was the highest for that month since 2009. So that's a pretty big, just in terms of like since 2009, like that's a big number. And I will mention we have a bunch of episodes that get into kind of what we would do, like if you lost your job and things like that. And they'll be in the show notes. We've got like 2 Friends on Fire episodes, 2 different Inside Out Money episodes that I think are helpful if you're particularly stressed about your own job, because we're not going to get into as much detail on that specifically today. But we'll put some links in these show notes to that specifically. Okay, so with that out, let's just talk about some other economic indicators. Again, back to what we said, like at the end of this, we're going to get into like what we really think matters for the average person to like think about and worry about. So stick around for that. I don't want this, if this is like overwhelming to you, just sort of like listen, let our voices lull you into a sense of meditation, and then come back to focus at the end when we share what really matters, what we think you really need to like worry about and what matters.
Yeah.
Let's start with like Andrew. I'm sure you love talking about the GDP.
I love talking about GDP.
Yeah. Tell us about the GDP.
So GDP, gross domestic product, it's a measure of the total value of goods and services produced, and it's a huge indicator of the overall strength of the economy and overall economic output. And so it's probably the most, it's one of, if not the most tracked metrics that economists use in evaluating the country's economic situation and the world, right? All global economies measure this value. The U.S. economy had real GDP growth of 2.3% in the fourth quarter, and this followed a 3.1% increase in the third quarter. And so right now, a good amount of what is driving the market is that people are revising their 2025 GDP forecast because of all the different things we're going to talk about, whether it's primarily the potential impact of tariffs on GDP growth.
Yeah. Okay, well, we're going to talk more about like tariffs and trade wars and all that that's going on soon. So another metric is wage growth. And so this is a little bit more clear than even what GDP is, but it's just how wages are actually growing. And so the December wage growth rate was 4.2%, moderating from 2023 peaks, but still faster than it was in 2020. So the average hourly wage growth has actually been outpacing inflation since May of 2023, which arguably would increase Americans' purchasing power. But there are also a lot of employers that are reportedly trimming workers' hours, which could change overall income and actually lower wage growth. And so this is one where we'll get more into like consumer spending and some other things. But as wage growth slows, consumer spending definitely can take a hit.
Yeah, this is the stat I was looking at. So I track, I have a spreadsheet of my salary increases, and I also I include the inflation rate. And so I was looking at it the other day to just look at it. So it's up 24. Cumulative inflation since 2020 is 24%.
That's crazy.
That's crazy. Yeah.
So we're talking about inflation now. I just didn't know if we even like said that, but.
Yeah. So it was interesting. I was buying bagels yesterday. I like using simple products, right? That have not changed over time, right? When I was buying bagels in high school, they were 50 cents, right? And
for a whole sleeve of bagels?
For a single bagel is 50 cents and a baker's dozen was like $5.50, right?
Yeah.
And yesterday I bought bagels at the local bagel shop, and it was $1.75 a bagel.
Yeah.
And not very long ago, it was $1.25 or even $1. And the cumulative inflation since 2020 is 24%. And so if you had $1 in 2020, think just right when COVID was hitting, 5 years later, that dollar, something that was costing $1 is now costing $1.24. And so if your wages are not 24% higher than where they were in 2020, which is highly unlikely unless you saw
most people's are not,
right,
unless they had like a
right.
large scale promotion,
right?
Yeah.
Something like that. And you've essentially have a pay cut in your purchasing power. And that is the crunch that the consumer is feeling. And obviously eggs is the highlight right now, which is funny that you and I both don't eat eggs.
I've been eating eggs lately, actually.
You have been?
It's funny, yeah. In the past 6 months.
Okay.
I've been introducing some.
You've slacked
It's
off.
funny that you're moving to plant-based.
Yeah.
I'm starting to kind of move. Not as in cheese is like a special occasion maybe, but like eggs lately, I'm sort of.
Yeah.
I'm going through some I'm not one of those people that's like you can't get enough protein from plant-based stuff because you totally can.
Right.
But I'm just like at times want certain things. Anyways, we're getting off topic.
Yes.
But
Stay
eggs
on
cost
topic.
more. Yeah,
right.
eggs cost more.
So eggs clearly because of a whole variety of reasons, right? The bird flu and all that. But simple things like what's the slice of pizza cost? What is a bagel? What's a loaf of bread? What is a gallon of milk? Like all of these staple items that have not changed at all in the last decades, right? And what they cost now.
Well, and that 24% that you were quoting is across the board, right?
Yes, cumulative
Food
inflation.
and certain categories are noticeably higher, right? I think we can all point to examples like the bagels where it's like, I knew exactly how much a can of chickpeas at Aldi cost 5 years ago, and it costs a lot more now.
Yeah.
And, all those things, they add up. So like inflation is higher and it is growing faster than anyone wants it to be growing right now.
I also really like looking at the monthly report they publish where they actually show all the categories and what is going up and what is going down.
Yeah.
And the one that has been the top of the list, which I have absolutely felt, is insurance. Whether that's car, home, any type of insurance, it has typically been the number one inflationary item. And when we look at our household spending, it definitely translates to our insurance is significantly higher than where it was.
Yeah. I noticed that on real estate taxes too, because like on our rentals, where we in the short term would like profit every month, like we don't on some. And there's some massive price increases. I'm not measuring the profit of my own personal home, but I am on the rentals. So so you're looking at that on the consumer price index?
Yes.
Every month? Yeah.
Right.
Okay. So the consumer price index actually measures inflation and the rate at which the prices of goods and services.
Yeah, they do
rising.
a basket of goods and they track it every single month.
So inflation is high.
Yep.
Which leads you to consumer confidence.
Yes.
Which is another metric. Also consumer spending. It's a major driver of the U.S. economy. Andrew, you work in the retail space, right? We've talked about how like consumer spending is down. There are organizations that do track retail sales and consumer confidence, and it provides insight into how willing consumers are to spend money. And so when consumer spending decreases, it's a sign that people are worried about the economy. And consumer confidence has been declining. So there's a University of Michigan index of consumer sentiment registered 57.9 in March, down from 64.7 in February. So that's just 1 month, and that's a solid amount down. The Conference Board's consumer confidence index also declined in February to 98.3 from 105.3 in January. And a lot of people, people would attribute those declines to a widening global trade war, federal job cuts that are happening / more anticipated. And when I say trade war, I'm talking about, the tariffs and then what is, the sort of trade war that is coming as a result of a lot of threats of tariffs.
So one thing about consumer confidence, why it's such an important tracked metric, is that so much of the U.S. economy is tied to consumer spending, and so that's why it's a big percentage of the GDP, and why it's so important. And
it's not always rational. It sometimes is tied to like consumers get spooked sometimes by hearing what they hear in the headlines and seeing that the market's not performing as well, and all of these other things. So
next is that's after consumer spending. A good segue next is into interest rates, and interest rates have been in the headlines for the last couple of years as the Fed continued to raise rates to try and slow down inflation under control. and interest, the Fed sets what the interest rates are going to be, and then that sets what mortgage rates and credit card rates and auto loans are going to be at. And so the cost to borrow money is significantly higher than where it was. Now, on the flip side, it's the reason why your savings accounts are paying out at over 4% on a high yield savings account today. But the other side of that is mortgage rates are at 7%. And when you do the math on how much house you can buy for a $2,500 mortgage payment at 7% versus what that would be at only 4%, it's a huge delta.
Or back when it was like, high 2s, 3s. Remember that? A lot of people have mortgages in the 3s. It's nice. Yeah. Okay, so what we just talked through were a lot of different economic factors and conditions. Let's talk about some market conditions. There's just the general stock market volatility, which is what we're going to talk a bit about today in terms of we've seen a lot of volatility recently, right? Even just in the past couple weeks. And so after there were some it was for a while, every day, I really only track my net worth monthly, but I keep an eye on things, and I see Purple Life will post sometimes, someone who's early retired that I follow on Instagram, and she'll post that she's, her net worth has reached another all-time high. So it's there's all these all-time highs that have been happening with the market. And then over the last couple of weeks, the markets have really pulled back, right? The S&P 500 has dropped 9% since peak in mid-February. There's a lot of people, big names, selling off, large funds of things. After Trump announced plans for increased tariffs on steel and aluminum from Canada and threatened, whatever you want to call it, of other potential tariffs, there's been a lot of people selling stock off. What is happening in the stock market is not always rational or explainable, right? It doesn't always equate to, sometimes something happens and kind of spooks activity in a way and creates different conditions that cause, large sell-offs and other things like that do affect prices. But regardless of the reasons, there's been a lot of volatility in the stock market recently. And I think that's actually what motivated us to do this topic right now, is because that does spook a lot of people. So when we talk about long-term investing, and we'll get into this, but when people see the market down, like you were talking about earlier, Andrew, back in, 2008, 2009, it makes people start to question their tactics and what they're doing and, where they're putting their money.
Yeah. And the number one thing that the market doesn't like is uncertainty. And that's what the tariff conversation has brought. And that's why we've seen a fairly rapid decline over the past month. But also, to put things in perspective, the S&P now is back to where it was in middle of July of last year.
Yeah.
So when you look at, I love looking at the S&P chart minimum 10 years, right?
Yeah.
So I love zooming in and zooming out.
You gotta zoom out. Zooming out.
You gotta zoom out, right? Because, if you zoom out even over the past 20 years, right, what we've experienced is a small little blip.
Yeah. Yeah, you can see when you zoom out, you can see the tiny blip of what happened in 2008 and 2009. You can see the little blip of what happened in 2020 with COVID.
Right.
Yeah. But so right now there are a lot of fears about a recession, right? And they're growing and increasing. A lot of economists are increasing their probability estimates for a recession within the next 12 months. But also that's been a prediction for years. There's been a prediction. Back to those, I was reading older headlines earlier, but there's been talk, I feel every year for the past few years of we're about to head into a recession.
No,
we've been riding these highs for a while.
The negative headlines get more traction than the positive ones. And so people love somebody who is projecting that the market is going to crash. And throughout the history of time, right, for the past 50 plus years, there's always been at least one person every single month saying the market is going to crash.
Yeah.
And the sheer numbers would say somebody is going to get lucky, right?
Yeah.
And then you have these people
and then they quote, I'm the one that predicted
I'm the one who
this.
predicted the housing crash, right? I'm the one who predicted the 2008 recession. I'm the one who predicted the dot-com bubble.
Yeah.
They all get book deals, right? Something like that.
Yeah.
And it was mostly just pure luck.
So, but on that note, there's a CNN Fear and Greed Index, and they have moved their index to the quote extreme fear category, which is back to your point very early on, Andrew, of like fear sells, right? And unfortunately, we're not trying to prey on the idea that fear sells. We're actually trying to like assuage your fears and make you feel better about your economic future, while also being, like I like to be cautiously optimistic. Cautious being the key word. So. Okay, the final element. You want to talk about what's going on like politically and economically? We keep saying it.
Yeah, let's talk about trade wars and tariffs. So this is a complex subject. There's a lot of differing viewpoints on this, but I will try and break it down. There's a lot of rhetoric in this space, and both sides of the aisle have got their points of view. So let's start with what a tariff is, right? A tariff is you're importing a good into the U.S. and the U.S. is going to tax you on that good, right? So you're going to import apparel. A lot of apparel has about a 10% import tariffs. You're going to import something that costs you $10. You're going to pay $1 tax to the U.S. government in order to bring that in. And so what President Trump has outlined is a number of different categories that they are increasing those tariffs for certain products and coming from certain countries. And the big debate about it is who actually pays for those tariffs. And it's not a very clear picture. The concept that the country that is exporting pays all the tariffs, pays the cost of the tariffs, is not true.
It's false.
It's false. And at the same time, the saying that the consumer is the only one who pays the tariffs,
the only one who gets hurt,
that is also false. As like with most things, it's not black and white. I'll give you an example. A lot of times the suppliers of the country that is exporting, right? So I'll just use China for example, right? You got a Chinese manufacturer who's manufacturing widgets, and suddenly they have an additional tariff that's put on them. Now, some people would say, well, China is going to pay all of that tariff, but that's not the case. But the supplier sometimes will make concessions to say, hey, I will drop the price by X% in order to help offset the tariffs that you're going to pay. So in that case, the Chinese supplier is helping to defray some of those tariff costs. But I've never seen, in all of my global trade dealings, I've never seen a supplier absorb 100% of that tariff. It's economically, a lot of these manufacturers, they're running on fairly thin margins. There's no way that they could cover it, right?
Yeah.
So then you go
Which means the consumer is going to pay some of it.
So now we go to the other side of, if the manufacturer can't absorb it, then there's typically the person who's importing it, right? The person who's actually doing the importing will also typically have their margins come down a little bit because they know they can't pass it 100% on to the consumer.
Yeah. And there's competitive. They're in a competitive market.
Correct.
So
then you get to the competition piece.
Someone's going to undercut them.
Right. There are certain brands that say, hey, I'm going to look at this as a market share opportunity. I am going to take a thinner margin. I'm not going to pass these prices on to the consumer, and I'm going to try and gain market share and take that from my competition. So you have the supplier will sometimes take a part of the tariff. You've got the brand or the importer will also take some of the tariff. And then ultimately you've got the consumer, right?
Yeah.
And then a lot of times the retailer, right? If you think about supplier, brand, and then retailer, the retailer will sometimes take on some of that margin hit. It typically is unlikely. And then ultimately they have to put the prices up to maintain their margins. And so then the consumer ends up paying for it.
Yeah.
And in a lot of cases that the consumer has the largest burden of all of those different people that I've talked about.
Yeah. But you think about, all the different things we just talked about, right? So if there are heavy tariffs placed on things, then it really intensifies a broader global trade war. It's increasing, the cost to the supplier, like you said. It's impacting their employment rates and everything else. It's increasing consumers' costs. It's having effects across all of these different pieces we just talked about.
And the other thing with tariffs and why they're such a challenge and can be very destructive to the economy is the speed at which they're implemented. So if you think about global supply chains are built over decades. And literally with a stroke of a pen, the benefits of how you designed your global supply chain can change overnight. And so, for example, you could choose to, in the example I was giving earlier where you've got a Chinese manufacturer, you could decide, hey, I'm going to move that production out of China and I'm going to move it to Vietnam or another country. And that is what a lot of the tariff talk is trying to do, because that does hurt the country, right? So as tariffs were put on China, there was a much larger incentive for brands to find new manufacturers outside of China that were not subject to the tariff. However, doing that takes a really long time, right? You've got to vet all those different suppliers. You may have significant tooling costs that you've put into China that you've then actually got to ship big tools around the world. You just can't do that stuff overnight. And so that's why the tariffs create such turmoil in the global supply chain, because you've kind of built and optimized it over a really long period of time, and then suddenly a tariff changes it completely.
Just like throws a wrench in it.
Yeah.
And we should note that Andrew actually works in international, should I say supply chain or like international? Yes.
International sales, supply chain, operations, all
for
of it.
For a large, Fortune 500 company. So he deals with this. He understands the wrench it throws in things.
I literally am seeing and talking about this every single day because it can have a big impact on the business.
Yeah. Okay. So in addition to that, you've also got, we briefly talked about this, but federal spending cuts. So there's a lot of like proposed and actual federal spending cuts, potential mass layoffs of federal workers. That's also adding to concerns about economic growth, consumer confidence, et cetera. And so look, we just talked about like a lot of different things. And that's the part where I was like, look, if you like glaze over when you hear this, start listening, quit your meditation now and start listening again of like, so what? Right? Like, why does this matter to you? What sort of matters versus just noise? And I think like technically all of this matters, right? It's incredibly important and critical to the broader economy. But in terms of like what you should spend your time following and worrying about and thinking about, I'd say most of the like average person listening to this podcast, they can't control any of these factors themselves. Perhaps you work in some sort of place where you actually can control it. But like, again, the average employee, when I was working in marketing, like I did not have a meaningful control over any of these factors, nor do you, Andrew. And so I think you just remind yourself of like, you can't control this stuff. Worry about the things we can control and just don't worry about the things we can't control. There's so much noise out there too, right? Like, I mean, Andrew, you were talking about at the very beginning, just all of the like sensationalized headlines and noise and what sells and like fear sells, unfortunately. And so there's a lot of things that we should kind of ignore, I would say, and like, or just think of as noise. So if we see it and read it, just like see it and move on, like all the short-term market fluctuations that are happening. I mean, there's market fluctuations happening daily, weekly, some pretty big swings, even in the past, 10, 15, 20 days, and a lot of speculation, a lot of like rhetoric on it and different thoughts. And I think you agree, Andrew, on like people don't need to like look at that and worry about it. And
yeah, I'm a big believer on focus on the things you can control and try not to dwell on the things that you can't control, right?
Yeah.
And make decisions on things that are in your purview and try and block out as much of the noise for things that you can't control.
Yeah. So you can't control the market fluctuations. You can't control all the things that are happening politically. Mm-hmm. You can't control what's happening with individual companies. Now, I will say there's like a lot going on with people boycotting companies that they don't, but they're canceling their DE&I policies. They don't believe in what they're doing. I'm all for that if you want to do it, right? Like do that. The power of, hundreds of millions of consumers can have an influence and can send some messages and can potentially influence the direction that certain things are going in. Now, I have been vocal on saying like, when there's a boycott on like a Friday and everyone's like, do your shopping on Thursday or Saturday. I'm like, no, that doesn't work. The sale, like monthly sales are the same. If you're going to boycott Amazon or Target or whoever, like you got to quit buying there altogether, right?
Yeah.
You don't just change the day you shop. Like obviously it can send a message to show how much consumers have power and can move the needle if they decide to change decisions. But that's less of what we're talking about today anyways, right? We're trying to talk at a, more macro level. But you do, I want to remind you, you do technically, you have control over your own day-to-day buying decisions, right? And so we'll talk more about that. Actually, we could talk more about that now, right? So don't worry about the stuff you can't control. Focus on what you can control. And like what this means to the average person is we're all starting to see price increases, which we've talked about. Many people are concerned about job security. Many people are concerned about their investments right now. And it doesn't feel good to see the stock market down. And it doesn't feel good to see your 401k.
I would argue, though, that if with the stock market down, I always like to flip it to say, hey, if you're in the accumulation phase, you should be cheering right now.
If you're still working and you're
still working and you're still dollar cost averaging, like we recommend.
Yeah.
Dollar cost averaging into the market, you're getting more shares for those dollars that you're putting in now. And, 20 years from now, you'll look at this period of time, just like I did back in 2010, and say, thank goodness I was kept on buying and dollar cost averaging into the market. I'm getting stuff on sale.
Yeah, I agree on the dollar cost averaging and the reframing it of stocks are on sale right now. And, I have my automatic buys set up and I'm getting a better price right now than I was 6 months ago.
Yeah. So just to provide that calming voice of reason here, reminding everybody about our long-term overall investing principles, you want to take a 10-year plus view of this. And when you zoom back to 10 years, that this period of time will be a small blip, and it is important to have that perspective. And now, if anytime you need cash in the short term, right? You need some money in the next 2, 3, 4 years. Yeah, you want to have that in a high yield savings account. And when you're thinking about investing, it's got to be for the long term. And if you take that long term view, you can navigate these ups and downs much, much better.
So Andrew, I have a specific question for you.
Yeah.
I want to double click on your calming voice and remind people the things you can control. You can control how you're spending your money.
Yep.
You can control how you're focused on your job and your career. And, how you're planning for any potential risks to your employment status, et cetera, which might involve how you're spending your money. You can control how you're raising your children, what you're teaching them about money. There's all sorts of things you can control financially.
And I'd add one more that kind of puts an umbrella on that, which is you can control your lifestyle. You can control...
Yeah, that to me is how you're spending your money,
right,
but you're right.
Your level of lifestyle.
Yes.
And one challenge here is that can you try and maintain what things can you cut from your lifestyle in order to help offset the inflationary pressures that we have today?
Yeah, totally. So one of my favorite episodes that I did with Liz is episode 36 of Inside Out Money, which is what we would do in a recession. There wasn't even one. I mean, again, this was, 60
Go
plus
back and
episodes
play
ago.
that one. Right.
Yeah. But at the time, everyone was talking about a recession looming like they are every day. And, we talked about all the things we do. It was titled From Canceling Netflix to Selling Our Homes and Downsizing. And so I do think it's a good exercise to really pull back your lifestyle right now. That's the way I am, because I like to be prepare for the worst, hope for the best. But the last thing you can control is how you're investing, right? And your investing strategy and approach. So my question for you, Andrew, is, and this is a statement and then a question, because I know you don't need the reminder, but I'm going to remind our listeners. Andrew and I frequently, especially when we're doing episodes together, we talk about from the book, quote, The Simple Path to Wealth, our belief in focusing on dollar cost averaging, investing in low cost total market index funds. You can go listen to episode 3 of the Inside Out Money podcast of how and why.
Our first episode.
Yeah, it was our first episode together. You're right. How and why to invest in index funds. But my question for you is, Andrew, given all the things we just talked about, are you changing your investment approach in any way?
No.
I will add to your answer. I am also not. If anything, I'm maybe throwing a little more into the market right now.
Right. I think there's no change in my overall thought process or philosophy that I am remaining invested in VTSAX. I have not been dollar cost averaging for the last couple of months because we had some short-term cash needs. I forget which episode it was. Oh, our end of the year spending episode.
Yeah.
You can go listen to that about all the home improvement projects we had to do last year. But we're rebuilding our cash reserves right now after that. So I hope we'll get our cash reserves back up where I'm comfortable with them, and then we'll be able to get back into dollar cost averaging with the market down 10% from its high.
Yeah. And again, you're not adjusting, how much you're putting in the market because it's down. You're adjusting it because you have some short-term cash needs. So
a personal
you're
personal
continuing
situation, right?
Yeah, exactly. You're continuing to live your life as you normally would,
Correct.
regardless of what's happening in the market, which is generally, other than saying, if you have extra money, it's quote on sale and it's a good time to, buy stuff. We don't know how much more on sale it will get though. But yeah, there's increased uncertainty right now. There's always uncertainty, and the market volatility is normal. It is a very cyclical thing. And there have been many market downturns and many subsequent recoveries.
And I also like to remind people that could you say last year that, yeah, the market was very high. We were at all times high. Did you expect this to happen? Yeah, I at some point, I was expecting, if you'd asked me back in July of last year, what's your probability that we are going to have a correction, which is defined as down 10% in the next 12 months, I would say very likely. However, what's tricky about timing the market is you can't be right just once. You got to be right twice.
Every time, timing in and out.
You got to be time the top and you got to be able to time the bottom. It's much easier to time the top than it is to time the bottom. And if you try and time, it's almost like you could get you can get the top right, but figuring out when to get back in is also it's impossible. And so that's the beauty of dollar cost averaging, where you're going to be buying all the way down and then you're going to be buying all the way back up, right?
Yeah. And I mean, you talk about, if you would have predicted this last year, a lot of people said like every year for the last few years, people were predicting something. And I was kind of waiting. I mean, I've talked before of like, I held on to some cash since I left work, and I've continued to waiting for stocks to be on sale. And while I was waiting, there's been like 20% years of, that I missed out on.
Right. And then you get into the mental gymnastics of like where we are today and the market's down 10%. And you're like, well, I'm just going to keep waiting because it's going to keep going down further. Right.
Yeah. Don't do as I do as we say.
Yeah.
Okay, so I mean, we've talked about all this. We should be taking a long-term perspective. Like Andrew said, if you need the money in the short term, put it in a high-yield savings cash account. But we're taking a long-term perspective, and you want the power of compound interest. And it is important to stay in the market. You know the phrase, time in the market is more important than trying to time the market or than timing the market. And you want to really avoid emotional investing, right? Like it is very dangerous, because that's when people get emotional and they start to get afraid, like things are going down and they're like, well, they're going to get worse. I don't want to be trying to sell at the very bottom, but like, I'm not trying to sell in the next few years. So even if the very bottom doesn't hit for another 2 or 3 years, like that's okay. Right. And we're really taking a long-term approach. So our guidance, and what we are doing, myself and Andrew, is like, we are sticking to our long-term investment strategy. We're, though we might look at the market performance every day because we're curious, I don't recommend you look at it every day, right? I like to track my net worth monthly. That's really when I look at it. And my net worth is down from where it was. But like you said, it's down it's back to where it was July of last year. Yeah. It's still way up. So when I zoom out, it's like the growth has been amazing since I left work, right? Since I early retired, and even better if I look even further back.
And the mental exercise that I will do to help with this is ignore your balances and just look at what you're buying it in at, and then you're like, okay, great, it's on sale, so I'm getting a discount, and it always makes me feel much better. Yeah,
I agree. It's a good way to reframe it. So look, you got to assess your own personal risk tolerance and think about the timing of what you're investing for and when you need that money and your own comfort level. But ultimately, we are not changing our investment approach. We are both still dollar cost averaging and buying total market low cost index funds. And we believe that we are diversified through that because it's providing a broad market diversification, and that index fund in itself, it owns a tiny piece of the overall stock market, of everything, in the overall stock market. Which again, if that doesn't make sense to you and you're like, wait, what's an index fund? Go listen to episode 3. Again, Andrew and I's first episode together, almost 100 episodes ago, which is crazy to think about. And yeah, I think we can wrap this up.
Yeah.
A few reminders, right? If this is overwhelming to you and you at times like don't know what to do or who to listen to, like you're not alone. It's normal. The world we live in today, there's an overwhelming amount of content and information and news sources. Some are more trustworthy than others. Some are more, clickbaity than others. And some are trying to purposely sensationalize headlines to get clicks and to make money from advertising. This is like by design an overwhelming environment that we are living in right now. But you got to have long-term perspective. We have one. We recommend you take that too. And it doesn't always feel great in the short term, but you got to push through those feelings and remember, zoom out, that you're doing this as a long-term play.
Yeah. So in closing, we can't control the market. The only thing that we can control are how we spend and manage our own money, and focus on those levers that you have direct impact on, and try and block out a lot of the noise that you can't control.
Yeah, I think it's a good thing to close on is remember that when the world feels out of control, you just got to lean into the things you can control, because it makes you feel more in control. Even though we're not in control of so many things, there's so many things you are in control of. And so put your time and energy into those. Like the stress of the world feeling out of control makes us want to spend more money. So it really takes a level of discipline to be able to say, nope, I'm not going to fall victim to that. I'm going to do the right things and do the things that will put me in a better position going forward. So we encourage you to dig deep and control what you can control. Okay.
Thank you for listening. We know your time is limited in value, and we appreciate you spending some of it with us. If you enjoyed today's episode, please give us a written review on Apple Podcasts or Spotify.
Andrew, we got to 250 reviews, right?
I know.
That was huge shout out and thank you. We had a goal of 200.
Yes.
We got to 250.
Yeah, so appreciate everyone jumping in on that and writing some reviews. We also encourage you to share this episode with a friend or family member to encourage ongoing discussions about money. You can also subscribe wherever you listen to podcasts. If you have thoughts or questions, we'd love to hear from you, and you can leave a voicemail or text us at 404-981-3370 or hit us up on Instagram.
Awesome. Thanks, Andrew.
Thanks, Maggie.
Bye.
Bye.
We go